Thank you, Tony. Yeah, this is what I wanted to see. Cool. That's exactly what I wanted to see. All right. Get everybody in here. How are we doing? We're early. We're early. This is good. Good. Let you guys all get in here. And meanwhile, I'm going to work on a couple of things because I want to help you guys as much as possible today. So there we go. Thumbs up. Good deal. Thanks, guys. Appreciate that a ton. You guys are awesome. And 1.2. All right. See if I can price one more loan for you guys because I know you'll probably ask. There it is. Investment property. That's us. Okay, cool. Good deal. Push that off to the side. Minimize that. Minimize that. And our presentation, which will now take over the screen as soon as I can put eyes on it. There it is. All right. Hello, everybody. Tony has welcomed you guys in. I am going to move to share this over to our presentation. And then we're going to start from the current slide. Cool. And that's, this is not the current slide I wanted. Let's back up. Oh, really not the current slide. Click, 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 click. Sweet. All right. That, and I got to open up a chat box so I can see everybody's questions. You're welcome, Angela, for lunch. Glad to have you over here. And we're going to let everybody get in. Give me a shout. Good thing. Okay. Okay. Thank you, Tony, for noting that. I appreciate that. Where do I see that part of it? Oh, so we're only going to be able to do this? Okay, good. So, all right. Perfect. Upload to same screen. Let us know if you're in chat. Okay, so if you guys want to interact with us, we're going to be doing that through the chat. We have a very large number of people. So we have a very large number of people. So we're not using the standard Q&A. We're going to have a chat screen. We have over 100 people registered today. As such, we're going to use a specific chat screen so Tony and I can kind of monitor what's coming through. We got our link for the training got shared and went out a little bit wider than we normally go. So I just want to make sure that we have a little bit better control of what's going to be shared with you guys and yeah, make sure that we've got everything covered. So with that, Raven's giving me a big heart. Appreciate that, Raven. Love talking to you. And it looks like I got to get Teams I got to get Teams off as well because the Teams is interrupting. Cool, we're at 12:02, so we're going to get started. Let me just shut Teams down and let them know I'm not available. All right, so our sponsor for this is Agnes from More Cleaning. Agnes, unfortunately, is in the process of picking up her daughter from the airport, so she was not able to make it here to introduce her services, but we've used Agnes in the past. If you guys ever walk into a house that needs a clean out before you list it, or maybe your clients are actually looking for somebody to come in and clean after they move because they don't want to do it, they're too busy unpacking in their new place, we strongly recommend Agnes. Tony has added Agnes's information into the chat for everybody. So you guys will see her information. We have asked her that if she is available to come check in with us and yeah, come check in with us and let her do a little demo of the things she can do. But if you guys are in the need of a cleaning service, we highly recommend Agnes and her team to do any of the work that you may run into in your real estate needs. Now, that all being said, we're super excited to have this presentation. I am Richard Kimball with Cross Country Mortgage. Been here with the company, it'll be 12 years as of January. Was one of the first people here with the company when we were very small. We have since grown into the largest purely retail mortgage banker in the country. There's only two companies larger than us, and both of those companies buy mortgages on a wholesale platform from other lenders. We only work with our realtor partners and, of course, our customers, period. As such, about 1 out of every 35 mortgages in the United States is closed with Cross Country. Now, that being said, we also understand that there's a huge need. One of the reasons I think we've grown so much and why loan officers love being here and realtors love dealing with us is because we have a lot of product. I mean, a lot of product. So there's really lots of different mortgage options out there. And what we're going to go over with you guys today is some of those options that would be available to you. Now, yes, we do Fannie Mae, Freddie Mac, which is traditional conventional loans. We do bond loans, meaning IDA and WIDA if you're in Wisconsin, or ICTA, I think is what it is in Indiana, and all over the country. We've got all the bond programs. We do FHA, VA, jumbo loans, construction, HELOCs. The non-QM space, though, is very interesting. It gives you the ability to sell more homes and say yes to more potential buyers. So we're going to talk about that in a second. So as I already told you guys who I am and that, so we'll skip that. So what is non-QM? Let's talk about that first. Non-QM refers to qualified mortgage. So qualified mortgage is, if you remember back during the housing crisis, there was this thing out there written called the Dodd-Frank bill. In the Dodd-Frank bill, they basically said, hey, look, there's qualified mortgages, which means that the lender is usually following typical Fannie Mae, FHA, VA guidelines. These are qualified mortgages. Non-qualified mortgages are ones that fall outside of that because we're using non-traditional methods to determine whether or not somebody can get a mortgage. In other words, we have mortgage products out there for clients with no W-2s, no paycheck stubs, no tax returns, and those clients there are never going to qualify for a traditional FHA conventional mortgage. What the company has done is we've actually created a division that just does non-QM mortgages. We call it our signature product. Under the signature product, we do a lot of things, but what's important to you guys, most mortgage companies that you're going to deal with are going to be, if they move the mic closer, most mortgage companies that you guys are going to deal with are going to be taking that loan you sent them. If they're getting a bank statement loan or a 1099 or something like that, they're going to take that loan and they're going to try to broker it out. Now, the problem with brokers, and hey, brokers are fine in the marketplace and everything else. We're a mortgage banker, and here's what the differences are. A mortgage banker actually is going to underwrite that loan in-house. They're going to close that loan in-house. In a lot of cases, we may even still service some of those loans. What a mortgage broker does is take an application, process it, and then they turn it over to a third-party company. That's not to say it's bad, but you lose control. And once you turn it over to a third-party company, you kind of lose control of the process. Here across country, one of the things that's made us very successful, is we have control of the process from beginning to end, application to funding, our money, our staff, our people. So what is, so in short, before I go into the specific product lines, what this means is that right now we actually sell these loans out to Wall Street and out to big companies who like these types of products. They know they perform, they like the rates of return, and they're looking to place money so that they can get these rates of returns on performing assets. So we sell directly to Wall Street and to other companies that like to buy these loans through our in-house division through the signature product. Now, we're going to go through bank statement loans, full doc loans, asset qualifier, 1099, investor cash flow, and yes, foreign national. Couple of key points with this. Because of these products, we're able to use, obviously, we mentioned alternative credit or alternative income to get things done. Anytime that you as a real estate agent have a deal that falls apart, or more specifically, you have something where the client comes to you and said, yeah, went to my bank, I'm self-employed, they turned me down. That is an ideal referral to us because we can now look at that client through some different eyes and see if they qualify for one of these types of products where a traditional bank just doesn't have these programs. A traditional credit union doesn't have these programs. So let's jump in and see what we've got to offer you guys. First things first, a bank statement program. So it's an alternative means certainly to qualify your borrower, and it exists basically because aggressive accountants and savvy business people take a lot of deductions and it helps them with their tax burden. So they might come to a loan officer, and we see this all the time. Uh, Self-employed borrower tells the loan officer, hey, I make $200,000. And the loan officer's like, oh, that's awesome. You're self-employed. That's great. And they end up taking an application, they end up pulling credit, and they run automated underwriting based on this $200,000 figure. What they didn't do is ask for tax returns, because after their accountant got done with it, that $200,000 was actually 40. They netted 40,000. Now they're into a transaction, they've asked for tax returns, and lo and behold, you've got 40,000 and the client no longer qualifies. To the rescue comes the bank statement program. Basically, we can turn around and use the deposits that are coming in through either a business account or personal account. We can use either one. So we'll use the deposits to establish what kind of income that is there and that we can work with. So the deposits, if they're a lot closer to $200,000, guess what? We're using $200,000 to qualify. So we'll get, depending on the program, anywhere from 12, we could ask for 24, but 12 is pretty standard. 12 months worth of bank statements, either personally or business. And then we will analyze that to determine what income our investors will accept. Now, a couple program highlights on this. We can go as little as 10% down. I laugh when I look at this slide though, and I see minimum FICO at 620. Well, guess what's not happening if you have a 620 FICO? You're not going to be able to come in with 10% down. If your FICO is 620 under this program, you're probably looking at more like 30% down. That 90% or 10% down is really for somebody with, let's say, a 740 score or higher. So just keep in mind there's a little bit of flexibility. We're aggressive on the credit score, but if we get aggressive on the credit score, we need more money down. The reason for that in the big picture is these loans end up performing well because a client with maybe not the greatest credit has got a big equity position in the house, and they're going to make sure they make that payment one way or another. Loan amounts on this, we do some exceptions under 150,000. It does get a little tough sometimes in the city of Chicago to do some of these products because there's a 3% cap, and in the 3% cap, they include title. You start getting into a little purchase, let's say a loan amount of about 100,000, and the title for a buyer in our market is about $3,000. Well, that's about the 3%. And so there's no room for appraisal or any of the other standard charges we would have. So a loan about 150 tends to work out in Cook County, in the city of Chicago. If you go out, we could certainly make some exceptions and go lower. If there's any questions on the bank statement program, please put them in the chat and we're going to go on. So, bank statement, one of the other things with the bank statement programs, who could you talk to as a real estate agent? We just got done having a great class over here in Rolling Meadows. We flew Rick Ruby out from Charlotte, North Carolina. He's the owner and trainer for the core training. One of the things he taught our realtors was you should have a list of VIPs to call. VIPs include CPAs, financial planners, business owners, people that you network. Those are going to be all great candidates to discuss something like a bank statement program. Bank statement programs, perfect answer for somebody who might struggle if they had to produce tax returns. Let's see. Oh, Tony told me I got a question in the Q&A. Thank you very much. I did not have the Q&A up. Let's go ahead and put that together. Thank you, Tony. Let's put that in a place where I can see it. Are these programs available? Oh, cool. So Mario asks, are these products available in any and all states of purchase a person could purchase in? Yes, we as a company do operate in all 50 states. And in every one of those cases, that loan application can start here in our office in Elk Grove Village, just outside of Chicago. And we can certainly facilitate that, whether they're California, New York, Hawaii, or just the next state over in Wisconsin. Let's see here. Elias is taking, Tony's gonna take care of that. That's perfect. And okay, so take care of that. All right, awesome. All right, took care of that stuff here. So next program that we have, and again, any other questions? So we have a couple other new messages. Great, no problem. Are these just residential? Yes, these products are just for residential 1 to 4 units. We are starting to look at adding some additional 5 or 6 units properties, but because we do sell to Wall Street, it's just cleaner to keep it as residential 1 to 4 units. Great question, Angela. And then on the mixed use, I would say see me on the mixed use, because there are some other programs out there. When you start talking about commercial, it gets a little bit more flexible because the lenders will rely on the building's performance, meaning the rents generated by the building, to sustain the loan more so than the borrower's information. So your borrower doesn't necessarily have to be as strong if the cash flow on the building is strong. I always say on commercial, which we do here, not under this program, but I always say on commercial that the building is about 70% of the approval process. So certainly keep that in mind. If the building cash flows, what's going on with the borrower is not as important as the building. Okay. And again, thanks for that question. And perfect. All right, next we have the asset qualifier program. So we've got some people sometimes out there that have a higher net worth, but either A, maybe don't even have a job right now, maybe, and think of somebody who maybe sold a business. So they sold a business, they've got a 1-year non-compete, they're taking some time to chill out, but you know what? They're going to take a little bit of that money and buy that next home or that dream home or upgrade their property or buy a second home. But they don't have a job because they just sold their business. So how do we get them qualified? So we can use their assets as a form of income. They are not required to liquidate them. They're not required to put them on deposit with us like some banks might do. We're just going to take a number and annualize their assets as if it were income. So if you've got high net worth people, this is a great tool. Now we do this through the signature program, but we also have a program that's very similar to Fannie Mae and Freddie Mac, where if we have somebody that's a little bit short and they've got a couple $100,000 in the bank, we can take some of that couple $100,000 in the bank and utilize that as income as well. So if you've ever had a situation out there where somebody's being declined for their debt to income, or well, they looked good, but the underwriter looked at their income and now it's low, but the client has a large liquid. By the way, this only applies to liquid assets for folks that are under retirement age. If they have a large liquid asset, we can use that and bring that into the transaction as income. All right, let's see here. Got about took care of the mixed use. All right, we are good to go there. Yeah, and on the bottom it talks about checking, savings, marketable securities. Retirement accounts would count if you were retirement age. They do allow crypto, so that's kind of a new thing. Crypto's been kind of like hot potato. Lenders don't like using it, but it is now, at least Bitcoin and Ethereum is allowed to be used as a potential asset for this. All right, and asset qualifier. Again, who are you going to talk to but asset qualifier? I would talk to business brokers. So if you know of anybody who actually their business is just to sell businesses, this is a great lead person. A CPA, a financial advisor. These are all great lead sources. If you have a VIP list, a list of people that can give you business but are not necessarily realtors and not Zillow, but a list of people that can give you business and refer you, you should be working that list. Um, okay, under our internal program, it does the total assets do have to exceed the mortgage program. Now that's for the signature program. For the other product that I discussed, where it's kind of a near miss conventional. Let's say somebody's working a W-2 job, they lost their overtime, they need a little bit more income. We can take a large liquid asset and supplement it, and that asset does not have to exceed the mortgage. It's a great tool and a great piece of flexibility. Ba, 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 ba. So Elias, that's a very, very specific question. So and I would have a lot more questions. So certainly we have ways to get a hold of you and get some more information about that. But essentially just for everybody else, Elias asked something that is more or less wanted to know if he qualify. I kind of look at a question like that when somebody says something is going to a doctor and say, I have a cough, but the doctor doesn't have an opportunity to learn more about you. Deep cough, heavy cough, is there phlegm, all this other nonsense. So I'd have to have a little bit more information to answer that question. All right, moving on. All right, this is a wonderful program, especially for real estate agents. Who can put in the chat or the Q&A how often somebody who only owns a home might be selling how often do you think they're going to stay in their first home? How many years? Throw me out some numbers, guys. Let's make sure we have some interaction here. Got some interaction from Angela, Elias, Raven. That's good. So what do we got out there? What do we got? 30 to 50 years, not the first home. So 15, 7. I think the old number used to be 7. So everybody would think that people would stay in their home for 7. That number, I think, went closer to 10 years that people would stay in that first home. But ultimately, for you guys as real estate agents, that means that person's not going to do business with you for another 7 years. Who is going to do business with you a lot sooner? Well, the people that'll do business with you a lot sooner are investors, because they're going to buy more than one home every 7 to 10 years. They may buy 7 to 10 homes a year. So you want to have these tools in your toolbox to basically say, hey, we've got programs out there. Don't think you can't qualify because you went into your bank and your bank said, hey, you've got too many investment properties. We really can't help you. Or, hey, you know what? You're self-employed. You're not showing a lot of income. I know you want to take some of that income or some of those assets you have and go buy rental properties, but we're not going to be able to help you. Yeah. So this program here, I love this. This has been out for 6 or 7 years. It's an investor cash flow program. The DSCR is debt service coverage ratio. What does it mean? It basically means, does the rental payment cover the mortgage payment? So that's how these programs started originally 6 or 7 years ago. They came out and said, look, if you had $1,000 mortgage payment, that includes taxes, insurance, mortgage insurance, HOA, whatever, the housing expense to own that property was 1,000. You had to have a rent of at least 1,200 a month. Now that's how these programs started. They have eventually evolved. So in fact, we can go down in that same example. I can actually have $1,000 payments, but as little as $750 a month in rent, or 75% of the rental. So they've gotten much more aggressive. These loans tend to perform really well, and that's why they've gotten a little bit more aggressive. In this situation, here's the advantages though, guys. We're not asking for tax returns. I'm not asking for paycheck stubs. I'm not asking for W-2s. On the application, we don't even list what the client does for a living. All of the income on the application is purely based on the rent versus the mortgage payment PITI. That's it. This is an amazing tool when you've got people, I've got investors that their only income is having 30 different investment properties. Guess what? With depreciation and write-offs and repairs and vacancy and management, all that stuff, doesn't look like they make any money. But yet they live in very well-to-do suburbs, drive nice cars, and the question is, they want to continue to buy more property. This is the way to do it. All right, so we talked about that. Let me buzz through here and see. Tony's got DSCR. Do you have to have a tenant already in place? Excellent question, Jessica. Appreciate that. Most programs would like to see a tenant in place. However, there are some exceptions, but most programs would like to see that you have a tenant in place. Internally, we just had a request come through for a cash out. And this is a great lesson for you guys too. We were going to be able to, we have a client that just bought a single family, bought it off market. So we got a good deal on it, went in, he's doing a bunch of work on it, bought it literally July 27th, went in, did a bunch of work on it, came to us and said, hey, I want to do a cash out on it. We did not require seasoning on that property. However, because it's so short, we do require a tenant to be in it. So, and we will cash that property out up to 75% or whatever it appraises out for. So he has an opportunity to get his initial investment back plus some moving forward without waiting 6 to 12 months seasoning, which is kind of more standard if you want to use the future value. So Jessica, for a lot of cases, you do need that. Some things that fall out, well, that's one thing I'll talk about. We do, of all of these signature programs, about 35% of the ones we close have some sort of exception. So if the borrower that's coming to us for this loan has 6 or 7 other rental properties that got a long track record of being a landlord, and they have great credit, good assets, we may make that exception that there isn't a tenant in the property. But for the most part, they'd like to see that. All right, Elias is in New York. All right, Elias, we still have to get back to you on that. I do appreciate the question, but we're getting slowly but surely, we're getting all the little pieces to that. We will definitely help you. Okay. One thing, last thing on this investor cash flow program. The banks used to be the places that you would go for this type of money. Now, bank or commercial lending tends to be a 5-year balloon because the bank has nowhere to sell that loan and they want an opportunity to improve their interest rates 5 years down the road. This product I can do as a 30-year fixed. So as a 30-year fixed, then my landlord knows exactly what they're going to be dealing with as far as a mortgage payment relative to any increases in taxes and insurance. So who is my target borrower and where do I refer them? Well, this is another tactic for you, the real estate agent. One of my mentors, Rick Ruby, he talked about this on stage. I'm not sure if he did when he was here in Rolling Meadows or when I saw him in Dallas last week. He owns a commercial office building. He owns a 10,000 square foot man cave. He owns a property on the lake. He owns a farm. Never has a real estate agent called him to say, how else can I help you? So one of the targets that you guys could choose would be mom and pop real estate investors. Well, where the heck do we find mom and pop real estate investors? Well, they're the ones that have the for rent sign scribbled and stuck in a window, whether it's commercial property, a residential property. These are people that may need to work with an experienced realtor. And if they've got that property for rent, if you see a property for rent and it doesn't have a flagged sign, Remax, Caldwell Bank, or whatever sign in the window, if it literally just says for rent, you should be reaching out to that person, getting to know that person, because maybe they may want to sell that property or they may want to buy some other property. So that would be a great contact to target, especially for this program. Okay. We'll go off of this. We got any other questions? Our questions are clean. Okay. In the signature program, we do a full doc program. Now, somebody might say, hey, Rich, why would you do a full doc? Isn't that something that normally you could send back to Fannie Mae, Freddie Mac, or FHA? This is kind of a fallout program. So this is a program that if the borrower doesn't quite fit the credit box, we're still going to do this and consider this under our signature plan. So under the signature plan, some things that could be considered recent credit events, like a foreclosure. Fannie Mae and Freddie Mac will not touch somebody in a foreclosure that isn't tied to a bankruptcy for 7 years. They have a shorter window if it was tied into a bankruptcy of 4 years and potentially 2, depending on circumstances, whatever. But if it's just straight up a foreclosure, then they're 7 years out from that. If somebody's coming to us after the foreclosure, let's say they're 2 years out, they've got the good down payment, they've reestablished their credit, that is somebody that we can help under this program. Maybe we have a client whose debt to income ratio is 55%. They're looking to borrow more than FHA would lend them because FHA would go to 55%. And let's say they have high income. So we look at that and we say, yeah, you're at 55%, but the amount of money you have left over after your payments, after taxes, is still pretty darn good. Your credit's good. We're going to make that exception. Let's talk about non-warrantable condos. And non-warrantable condos is interesting because the question is, why is it non-warrantable? So some of the things that we would consider, so first of all, what's a non-warrantable condo? Let's back up, right? That is a condo that does not qualify for traditional FHA, Fannie Mae, or Freddie Mac financing. Typically, you're going to find things that don't qualify the condo is higher delinquency than normal. You're going to find, oh, Agnes has made it. Yay. Okay, good. So Agnes, can you hang out while I finish my point on this program?
Yes.
Okay, good. Hi, good. Welcome. So
Thank you.
non-warrantable condo is going to be maybe there's some commercial in the first floor. Fannie Mae doesn't like that. Maybe the delinquency is higher than normal. Fannie Mae doesn't like that. Maybe the reserves are a little bit off for a reason. Fannie Mae doesn't like that. Those things could potentially qualify with us as an exception basis. One thing that's probably not going to qualify, but still considered non-warrantable, is a big lawsuit. So we've seen some associations who unfortunately are on the wrong end of a big lawsuit, and nobody really knows what the liability is. So you don't really know what kind of stress the condominium project's going to be under, depending on the outcome of the lawsuit and the cost to defend themselves. So that's going to be something a lot of people are going to walk away from until that type of thing is resolved. Also, so with that, we have our food sponsor, and I want to thank Agnes quite a bit. Agnes, I did promote you as somebody who will help with cleanouts of properties, help with post moves and things like that. So Agnes, I want you to introduce yourself, and again, everybody give her a big warm welcome as she did pay for your lunch today.
Hello, do you guys see me? I'm not sure because I cannot see my face.
We see you just fine. I'm in the middle of a
Oh.
PowerPoint, so your face is probably a little small on especially on the phone.
Okay. I'm sorry, live. I'm still at the airport. I was just picking up my family who came from Europe. I was not expecting to be here at this minute, but life is unpredictable sometimes. And I'm sitting here, and thank you, Richard, for giving me an opportunity to promote myself and talk a little bit about my company, More Cleaners. So this is my company is based in Bloomingdale, but we serve Chicago, Hinsdale, Highland Park, Northbrook, Schaumburg area, pretty much like 30-40 mile radius around Chicago. And so we do residential and commercial cleaning. So maybe for your people who are watching your webinar today, as you guys do like reset, so we do like move in and move out cleanings for like people who buy or sell properties, and also regular cleaning. And for residential cleaning, we try to use organic cleaning products.
Nice. Nice. That's awesome. Well, Agnes, I know you got a bunch of, you can't see the chat, I'm sure, in your car, but Adeline, thank you. Dan, thank you. Barbara, thank you. Angela, thank you. Mari said she's already added you to her contact list. Bodie, thank you. Everything for lunch. Again, guys, if you're looking for any cleaning service, then you definitely need to consider Agnes and her company. And now you've got the contact in the chat. Agnes, we appreciate you showing up, and I know a little stressful because the airport's never a lot of fun to get in and out of. Trust me, I know. So I do appreciate you. Thanks for showing up. You could hang out if you want. I'm going to jump back into the program, and you got a lot of props in the chat, so that's good. So see, Barbara mentioned that you might be a good closing gift for a homeowner too. Good idea.
Mm-hmm.
Nice little closing gift, give you a free cleaning of the new house or the old house. So that's awesome. Okay, good.
Yes, that sounds all great. Yes.
Yeah. So Angela wanted to know non-warrantable if they don't have a valid homeowners association in place. That could be a potential exception. So new projects and condos tend to be, the associations really owned and managed by the builder until they complete the project and turn it over to the homeowners themselves. That's a place where Fannie Mae and Freddie Mac get a little bit sketchy. They really would prefer the association be in the ownership of the owners and not the builder. That is something potentially that we look at under the signature program. So that's a great question, Angela. I appreciate it. All right. Moving on this asset DACA. Also under this program, DACA will qualify and ITIN will qualify under this program too. We're going to get into ITIN a little bit later. All right, on the full doc, again, you might have some fallout there, some borrowers seeking some additional, some unique features. This is stuff that we're going to be able to look at and help them out with. And next, we go to foreign nationals. So these are borrowers living abroad but financing investment properties or second home in the United States. Foreign nationals is kind of a tough. Like Fannie Mae doesn't like them, Freddie Mac doesn't like them, FHA for sure doesn't like them. So, but with foreign nationals, they usually can't obtain traditional financing. They definitely require a bigger down payment. As you can see, this is the first time our loan to values went from 90 to 75%. These folks might also not have a FICO score because they don't have United States credit, and that would be acceptable under this program. So yeah, we would either qualify them off of a DSCR. Let's say they're buying rental property here in the United States, or maybe assets that they have that we can use to qualify them. So there is some product out there for some folks that do want to buy real estate here in the United States, but don't have either the proper work visas and things that would be considered by Fannie Mae. Again, colleges, businesses that have employers that are employees that live across the pond, so to speak. So those would be some areas that it might help, like where you could target people. So if you live any near a college where people are coming in from around the world, or if you live near a corporate headquarters that has offices around the world, these might be places where you would find some of these potential borrowers. Okay. 1099 program. This is kind of newer to the game. It's probably only been out about 3 years, where the investor cash flow has been out about 6 or 7. But the 1099 program is really interesting because we have now kind of drifted into this gig society. You're talking about Uber drivers, Lyft drivers, and things of that nature. These would be really good folks that could potentially use the 1099 program. These drivers have a ton of write-offs, mileage and wear and tear in the car, depending on how their accountant's going to approach it. So using a 1099 might be easier to get them approved than diving deep into their tax returns. Here's one of the keys about the 1099 program. If we're going to be providing 1099s, let's say we have 1099s that show that the borrower's making $60,000 a year. That's about $5,000 a month. We are going to look for 4 months recent bank statements that back up the 1099 income. So if the 1099 says 60,000, the bank statements show roughly 5,000 in deposits, because again, this is non-taxable money. So it's, if you're making 60, you're getting 60 in the bank, then we're going to use that income to qualify it. Let's see, make sure I don't have any questions. I saw some stuff going through. Okay, good. And the Q&A is clean. This is a wonderful, wonderful program as an alternative, especially with gig workers or independent contractors. Fantastic product. Again, who do you talk to about the 1099 program? Gig employees, independent contractors, tech workers, financial advisors. There's a lot of RNs now that are doing some contract works. IT people do contract work. CPAs are going to know these folks. Other tech workers are going to know these folks. You know, they're making money. They just need to get qualified, and this is a perfect product for that. All right. Commonly requested exceptions. I mentioned to you guys that 35% of the loans we close under our program close with an exception. Here's some of the exception examples. No landlord history. So that would be potential DSCR loan. Somebody's coming in, wants to buy an investment property, they don't have landlord. Higher loan to value exceptions. So let's say on our somebody with a 620 where our credit loan to value max might be 60% or 65, maybe we'll make a 5 or 10% exception based on assets they have or experience that they might have. Some FICO exceptions are accepted. Again, we talked about the fact that we would go below 150 and we would go higher on an exception basis. The DCR below minimum requirement, we did mention that we would go down to 75% of the PITI payment for rent. And this is more important because, you know, values sometimes in some areas have shot up even more than market rent. And if your market rent isn't covering, this is still a great place for us to take that exception. Excessive NSFs. So that's a big deal. In a lot of these programs, we're relying and looking at bank statements. So financial mismanagement is definitely considered having a lot of NSFs. So if we can get a good reason why that statement might have had those NSFs, and maybe we can even isolate it over a month or two, not over the whole 4 months, if we have 4 months or 12 months, depending on the program, we can make those exceptions. Declining deposits, again, we can make an exception for that under our bank statements. Housing payment history not documented. Somebody's living at home, somebody's paying cash as the rent. We can actually work with that. Yeah, we talked about multiple non-warrantable condo features. Housing payment history. Maybe they were 1 times 30 on a mortgage in the last 12 months. So that's a big deal. Is the interest rate higher for this loan? Great question. So I looked up, so we got that question in the chat. I want to tackle that one. Hang on, I want to go back. Tony was really efficient, got that out of there, but that was asked by Ty. Excellent question, Ty. Thank you very much. Excellent. So, I had priced a bank statement loan with 25% down, higher credit score. That rate came in today at 7.5% on a 30-year fix, charging a point and a half. So that's a pretty darn good rate for a loan that I can't take to Fannie Mae. I can't take to Freddie Mac. I'm just using the bank statements. I didn't see tax returns or paycheck stubs. That's a pretty competitive rate. So hopefully, Ty, that answers your questions. Lower credit scores are going to dictate higher interest rates. Just the rate equals risk. So just keep that in mind. Let's see, use of business assets with less than 51% ownership. That is a big deal. So I can still use some of those assets, even though they might be let's say there's three brothers that own the business, and they're a 33% owner. A lot of times they won't let us use any business assets, but in that case, we can make that exception. Use of business assets without an accountant letter. Fannie Mae and Freddie Mac specifically state that if you're going to use business assets, you need a letter from your CPA that states pulling money out of your business account isn't going to have a negative effect on running that business in the future. Like you make your down payment on your house, but now you can't make payroll, that type of thing. All right, get another question from Angela. Are there prepayment penalties if they want to refinance once possible? Some programs will have a prepayment penalty. You're going to see that more in the non-owner occupied space. You will not see it in the owner occupied space, but the non-owner occupied space, you won't see it as much with us. There are some prepayment penalty options to lower a rate, but there's always a way to buy out a prepayment penalty. I know that we had a really unique situation where it was really unique DSCR loan, and that one had like a 5-year prepay. So, and that is the only lender I could figure out that would even do it. So it is what it is. But for most cases, we can buy out those prepays with a higher rate of interest. Exceeds max acreage. So if you got somebody buying something with 20 acres, traditionally Fannie Mae is going to stop the valuation of the land at about 5 acres. So if you've got something at 20 acres, you're not getting any credit for those last 15. We may make that exception with regards to that. Hobby farms, nobody likes doing loans on working farms. USDA doesn't do loan on working farms, but hobby farm where somebody's like, they just have horses as a passion. Sure, we can do that. Okay. And all right, good. So insufficient trade lines. So maybe they're not showing quite enough trade lines. We can make an exception if we can use some alternative credit references. So they're paying their cell phone bill every month. They're paying their cable every month. We can use some alternative credit references. We do accept multi-units with an ADU, which is an accessory dwelling unit. So the ADU, as long as we can establish that that ADU is legal within the multi-unit, we can do that. Borrower's minimum contribution, yes, if they have a gift per chance, that we can accept some gift and actually make an exception to the amount of money that they personally contribute. Reserve shortage is definitely something we can look at. Less than 2 years self-employed, that's a big deal. So the FHA, for example, wants people self-employed for 2 years before you would consider their income, period, bar none. Fannie Mae and Freddie Mac are a little bit more lax on that. You can get away with about 18 months. So we could still possibly look at something there. Ultimately, self-employed less than 2 years would be considered an exception. Deed restrictions, I'm not going to get too deep in the woods unless there's a question about that. Foreign assets not on the approved list. So maybe we have a list of things we would accept. There was some assets there that our borrower had that weren't on that list, but we made the exception because we could at least verify that they had it. Employer assistance, some benefits that you get from an employer are not allowable for income with certain programs. And Fannie Mae's got some tight restrictions on it. But if we know they're getting a check for housing or something like that, we can use it even though it might not show up in their W-2. Oil and gas lease, don't have to worry about that here. And of course, unique income calculation. All right. So other ways that you can make money here with other ways you guys can make money here and get more business and referrals. We have an affinity program. The affinity program says that we can go to an employer, a union, and we can say, look, if you as a company will market us being you guys, you the realtor, and us to your employees as a benefit for working here. We as a lender will basically discount our closing costs for access to those employees. And in such scenario, we would have an opportunity to be a link on their website. We'd have an opportunity maybe to go to that employer and make presentations about homeownership, about credit, about buying rental property. I only recommend somebody take advantage of this, you as the realtor, if in fact you personally know either the owner of the company or the head of HR. Otherwise, trying to cultivate these relationships it's a long runway, it's very tedious, and there's a lot of things that have to fall into place. But if you have access to an owner of a business or the HR company for a business, come see me about this and I could show you how to market it. We also have a product that will go through here. Oh yeah, this is our buy before you sell. So a lot of times you guys are meeting with sellers and the sellers are panicked because they need to sell their property in order to get to the new property. Either they need the equity out of the property to buy the new property, or like most people, they don't qualify with two mortgage programs. We have a couple different options where we can not only get them equity out of their existing home, but we can also help them not have to qualify for both mortgages. A lot of creative programs there. What I would tell you is that do not let a seller tell you that, hey, I really, really want to move, but I can't move because you're telling me in the market that we're in right now, nobody's going to accept a contingent offer. We know that's true in most cases. We have mortgage product that will allow them to buy the house without selling their property. So if you need more information on that, come see me. The clients that are selling, their information is specific. Sometimes they need the money out of their house, sometimes they don't. Sometimes they just need to not have that other mortgage be part of their qualification, and we have some tools and tactics for that. We do lines of credit. So if you've got somebody who's an investor, but maybe they're a little cash strapped, you could send them to us. We do have opportunities to do lines of credit. Some of these lines of credit are available on investment property, so we can do lines of credit on that. We have a very simple digital application, no appraisals done, no titles done, and it's an instant answer. Now it's a little rigid, so they're not really flexible because a lot of it's done on a blockchain kind of basis, meaning that they're relying on what they can find on the internet to see what the liens are on the property. They're relying on what they can find on the internet to see what the value is of the property. Because again, there's no appraisal and there's no title, or no official title insurance done on the program. So if you're interested in this for you or your investors and you want to get a line of credit that you may not even have to provide tax returns on, this is a great tool. See us first before we talk about the link. We'll get the link out to you. You apply and you get an offer instantly off a soft credit pull. So this is a great program as well. All right, that is our presentation of some of the many products that we have here to help you guys out. Now, I am open for questions. Wanted to thank Tony. Need more info on the investment line of credit? You got it, Raven. I will take care of that. Let me grab a pen so I could reach back out to you. Perfect. As a matter of fact, let's get this thank you thing off and you guys can see me. All right, good. So we have Raven wanted a question on that. Perfect. If there are any other questions, thank you, Angela, for that. I appreciate that. Any other questions, certainly throw them in the chat. Our next virtual lunch and learn is going to be Ask the Underwriter. I love this program. The Ask the Underwriter, we've been doing this one for about 3 years. We grab one of our cross-country underwriters. They are not underwriting this program. Please don't come to them with these questions. What they will ask is any questions you have on conventional, FHA, or VA. Any questions you have. We'll collect questions as we get into that. By the way, that's going to be September 18th at noon. We have our Ask the Underwriter program, and always learn a lot there. If you guys got questions about loan programs, anything that you need to know, bring your questions, send them in early. That's our next event. We do have a couple of questions that came in. Do I have a PowerPoint available for the presentation? Lots of good information. We'll get that out to you. Dan, does the 1099 program apply if the client is 1099 and W-2? We can make that exception, Tawana. So great question. So the question is, your client's W-2 and their 1099, can we merge, can we pull the 1099 income as part of the W-2? Yes, we can. So that's a great question. Are these programs available through any CCM? Jessica asked. Yeah, they should be available through any cross country. The signature program is available throughout our system. So if you are working with a cross country loan officer, they're great. You can seek one of those out. If it doesn't happen to me, that's totally fine. But yeah, these programs will be available. If you ask them about these programs and they have a question, please send them to me. I'm also a regional manager here, so I actually manage a couple hundred people. And there's some nuanced things that we do here out of this office that are a little different than some of the other branches might be aware of. But anyway, they should be able to handle all of that. Angela asks, do we do USDA? USDA, yes, we do it. And that is a program that's available to rural Chicagoans. What do I mean by rural? Think towns like Marengo, the west side of Woodstock, Harvard. Those are less densely populated areas. Those qualify for the USDA program, which allows 0% down, just like the VA program. So if somebody's willing to move or already living out in that area, somewhere outside of major metro Chicago, Huntley is an example, used to qualify until they dropped Del Webb in the middle of it. Now there's just too many people there, so Huntley no longer qualifies under the USDA program. But great question, Angela. Yes, we do those programs. Perfect. Got those answered. And let me make sure I don't have anything else. CCM, perfect. Thank you for the shout out, Angela. All right, guys, I think we've got everything there. Thank you guys for attending. And again, everything is possible. You just need to actually pick up the phone, call some folks, let them know you've got a product, let them know you've got availability, let them know rates are going to get better. And when rates get better, values will continue to go up. And investment in real estate is still one of the best investments. If you take anything else, by the way, when you're talking to people, the average net worth of a homeowner is 40 times, 40 times that of a renter. I want to create a lot more homeowners than renters. Thanks, guys. Have a great one. Bye-bye.